Good evening, everyone, and welcome back to Road to Financial Freedom with Pastor Kurt, Pastor Nedra. This is the fourth Tuesday of the month, and every fourth Tuesday we continue to teach upon and share about finances so we can get to the place where each and every one of us, where God would desire us to be, that we can be debt-free, we can live debt-free and have a prosperous life. And we've been communicating and discussing different topics about finances. We've talked about the budget. We've talked about savings. We've talked about debt removal. And last month, we concentrated and we talked about insurance, insurance as a vehicle, insurance as an investment vehicle, as well as a mechanism and a tool for us to have generational wealth, right? We know one of the challenges, especially in the African American community, is situating ourselves for generational wealth. And part of what we're trying to do on this evening, and part of what this journey is about, is positioning ourselves so that each year, one of the things we like to do is, as we take an assessment of our life, each year we want it to be the best year of our life, right? And financially, especially, is no different. Each year of your life, you should be becoming financially stronger, financially better. And the way to do that is to put principles in place. And many times, the challenge for many of us is we've never been given the principle. We've never been given the information in terms of what we need to do to get to where we desire to be. And just having the information, and then on your part, due diligence of walking out that information, walking out that instruction, will help you to get to where we would desire to be and where we would desire you to be, which is a road to financial freedom. And this evening, we're going to continue on in that journey, and we're going to bring up an individual who's near and dear to our heart, someone who's well-versed financially, but we're specifically going to be talking on tonight and allowing this person to teach on investing, so we can begin to deposit into the lesson. Once you get to the place, like some of us who are more mature, who've been around in a while, and our kids are out of college, we've paid for college, our cars are paid off. For some of us, the only debt we really have is our home, and we have discretionary income. We have finances after monthly requirements of bills are paid. It's like, so what do you do, right? And one of the things you have to begin to do is you have to begin to learn the investment tools that are available to you and how to invest. I stated from the very beginning, if you don't manage your money will manage you. And one of the challenges you have is once you begin to position yourself to have discretionary income and to have money left over from your paycheck, your main goal at that point is to keep those funds out of the hands of Uncle Sam, to keep those funds out of the hands of the IRS, right? And how do the rich get richer? The rich get richer by simply allowing their money to make money for them. The challenge, the poor gets poor because they don't have enough resources just to be able to survive. And the middle class is what runs the economy. The middle class, when they get money, they look to spend. And what you have to do is transform yourself, get yourself out of a middle class mindset. Every time you get a dollar, looking to buy the new whatever, PS4, PS5, the new iPhone, the new vehicle, looking to put yourself in debt, and begin to think about how could this dollar make me another dollar? How could this dollar make me another $5? How could this dollar make me another $10? So without further ado, let's bring up Shaun Thomas. Shaun Thomas is the fund manager for Axum Global, future billionaire in our midst. So you're getting him on his journey, right? So it's always good to see people on their journey. So when he's up there talking to Elon, you'll be like, I know him. he was on the road to financial freedom with Pastor Kurt. So welcome, Shaun, and thank you for agreeing to do this with us and agreeing to help the people of God. So I'm going to turn it over to you for your presentation, and then we'll come back at the end, and then we'll be able to answer questions that anybody has. So you go ahead and take it away.
Hello, everyone, and thank you, Pastor Kirk, for allowing me this time to present this Investing 101, Building Wealth Through Smart Investing. Do I have to do something to present? Okay, there we go. So, as an introduction to investing, first we want to understand the four functions of money, right? So, there's a saying there money is a function of four. So, it's a medium of exchange, allowing individuals to trade goods and services one with another. It's a store of value, allowing people to save wealth over time. It's also a unit of value, enabling people to compare the wealth the worth of different items. Sorry. It's also a standard for deferred payment. So it's very important to, even before you want to invest money, to understand money's functions. And those are the four functions. That's something you should probably look to memorize as you're going through your road to financial freedom, if you don't already know it. So what is investing? It's simply allocating money into financial instruments or assets to generate returns over time. The difference between saving and investing is saving is protecting your capital. Basically, you're playing defense. Investing is growing your capital. You're looking to play offense. Why invest? To build wealth, to beat inflation, to for financial security as well. So inflation is one that I think gets overlooked pretty often, right? Because even if you are able to acquire a lot of money, the Fed's job is not to keep inflation at zero. Their job is to keep it at 2%. So right now we're inflation, it was recently more like 6, 7%. So you saving money, you're losing money by saving money over time due to inflation. So that is the reason you would want to invest as opposed to just looking to save. Types of investments. Um, a lot of us have always talked about, stocks, real estate, bonds, commodities, cryptocurrencies, mutual funds, and ETFs. So here, basically, a stock is ownership in a company. You're part owner, right? So we have a lot of publicly traded companies. A lot of publicly traded companies you probably frequent, uh, if not daily, weekly. McDonald's, Walmart, Nike, Apple, right? Microsoft. These are all publicly traded companies where you can buy stock and participate in some of their profits and growth, right? Real estate. Real estate is as an investment property, not necessarily your place of residence, but if you can get some real estate as an investment, put some tenants in there and allow those tenants to pay the mortgage and hopefully cash flow. But if not, hold on to it long enough for it to appreciate in value. You'll be good there. Real estate is one of the vehicles that a lot of people use for a lot of different reasons. One of them being taxes, one of them being, depreciation. Um, there are also REITs where you can buy into a real estate investment trust and you split the profit. That's probably one of the easier ways to invest in real estate. where you don't have to necessarily worry about tenants. Um, bonds. Bonds are loans to corporations and governments that pay interest. So it's not necessarily as risky as the other two, but that allows you some security and allows you to continue to grow your wealth. Commodities, it might be gold, oil, and cryptocurrency. I'm sure everyone heard of Bitcoin. At some point here recently, it was going through the roof here. I want to say during the pandemic. It's kind of died down a little bit now, but as we become more and more digitally based, that is something that you should look to, keep your eye on and possibly invest if it suits you. So mutual funds and ETFs. Mutual funds and ETFs are probably some of the more is more like a intermediary between bonds and stocks, right? So it's not necessarily as risky as stocks, but you'll have more growth than you would with bonds, more upside potential. Understanding risk and returns. So this portion of understanding and investing is more about understanding who you are and what you are comfortable with, right? And also understand where you are in your journey. If you're towards the end of your working days, you might not want to take nearly as much risk as you would earlier in your career, right? So the more risk you take, the more upside potential, the less risk. You're probably looking for something a lot more stable. You just want consistent 3%, consistent 5%, consistently beat inflation, right? So if inflation is at 5%, you might want, something that at least brings you in 6 or 7%. So you're not losing money and you're also continuing to grow your account at the same time. Assessing your risk tolerance. What are you comfortable with, right? That is something that you will have to sit down and analyze for yourself. Everybody's goals are extremely different, right? So even though you might be, closer to the end of your working days, you might still be comfortable with risking, I don't know, 3, 5, 10% of your portfolio as opposed to just, putting it all in something extremely safe. Volatility and market fluctuation is a part of investing. It's a market because it goes up and it goes down, simply put. But over time, the expectation is for it to continue to go up, right? We are investing to make money, right? Not just to say you're investing. And the diversification is something that you can do to mitigate your risk, right? Are you invested in stock, bonds, and real estate? That's what I consider diversification. A lot of people, you might watch some of the guys on TV, Kramer and some of the others, they might want to know, what do you have in your stock portfolio? Is it diversified with, I don't know, a tech stock, a utilities, a healthcare stock, right? But for me, diversification, I'm looking to diversify across asset classes, not just in one asset. Right? As far as your investment strategies, now, what you want to do is, of course, you want to have investment goals, right? And within that goal, you want to determine, okay, is this investment a short term or a long term investment? Short term could be, you're trading, whether it be a cryptocurrency, Bitcoin or Litecoin or XRP or some of them other ones. It might be you like to trade Tesla or Apple or Google. Um, but what are your long-term goals, right? You might want to hold Apple long term. You might want to hold a Tesla long term. You might want to hold a Microsoft long term, or I think I said Microsoft twice, but Google long term. So you certainly want to have goals and understand the terms in which you're investing. You can have a little bit of both. You can have some short term, some long term, as you continue to as you build out a portfolio, right? Active versus passive. How do you want to manage, right? Do you want to be hands on? Are you constantly buying and selling, constantly buying and selling? Or do you want to, buy one time and check it every 3 to 5 months, every once a year, you know, twice a year, something like that. So these are all things that you have to look inward and determine, you know, your terms. Is it short term, long term, and do you want to be active or passive? A lot of people think that real estate is a passive investment, and I kind of disagree with that. I think real estate, especially if you own the properties, you have to constantly be engaged. That's more of an active investment. Stock, if you plan to buy and hold, that could be more of a passive investment. Bonds, passive investment. You buy in one time, you collect your your dividend monthly, quarterly, annually, how they pay out, right? So, and as far as what you're investing in, are you looking to invest in value stocks or value opportunities? Are you looking for growth opportunities? Are you looking for income? Right? These are all different strategies. Within a portfolio, you can have a little bit of all of them, but you want to make sure you know what you're investing in and why you're investing in, how long you are investing in it as well. So short term, is this a short term value play? Right? That probably wouldn't make that much sense. Is it a long term value play? That probably would make a little bit more sense. Short term growth makes a lot of sense. You want to be in, let it grow quickly, get out, right? So that's something that a lot of the day traders and the swing traders will do, right? They'll get in, look for it to run up or pull back, depending on what side of the trade they're on, and get out, right? So as far as an income investment, income, you know, or more along the lines of bonds, right? You just want something consistent, almost like a paycheck. You've invested this much, you expected a return, monthly, quarterly, annually of X, right? So that you can continue to pay your mortgage or taxes on, your paid off property, right? And as far as dollar cost averaging, uh, they always say time in the market beats timing the market, right? So dollar cost average basically means if you know you have 20 or $200 to invest, every week, you're going to buy you're going to buy into the opportunities that you've already identified, that you see as great investment opportunities, and compound by staying in those investments over time, right? That's, I think what they say, the eighth wonder of the world, compound interest. So you buy into something, you say, for instance, you buy a stock pays a dividend, you reinvest that dividend, and you can dollar cost average by continue to buy the stock. And over time, you'll a good investment will continue to grow in value. So building a portfolio, right? So you have to, of course, again, understand what you want to invest in, what assets, what is your financial goals, right? Evaluate your risk tolerance, right? What are you comfortable investing in? If it's your portfolio You should, one, know what you're investing in and be comfortable with what you're investing in, right? Because there could be a rocky period, and if you're not comfortable, 9 times out of 10 you're gonna dump it at the first sign of any sort of turbulence, right? So you want to evaluate your risks, choose your assets, diversify across asset classes, right? You want to buy a little bit of gold, some stocks, some bonds, a little bit of cryptocurrency, right? Um, Asset allocation, right? So, what is your timeline, right, for these opportunities, right? Do rebalancing it also. Maybe 1 or 2 year investments really moved a lot faster than you thought it would. So maybe it 10x, right, in a year. So that investment went from $1,000 to $10,000, but you only have another 9,000 invested. So now you got one huge position with maybe 9 other small positions. So you might want to sell off some of the the position that went from 1,000 to the 10,000 and diversify some of that profit, right? So common some common mistakes to avoid, right? Trying to time the market. That is something that a lot of people try to do, and it's very, very, very unlikely that you'll get it right, especially consistently, right? So your best bet is to start as soon as you possibly can, you know, because predicting a market is extremely tough. A lot of people try to do it, and the people that do try to do it, they all often try to sell you a product where that product that they end up selling will outpace their ability to actually time the market, right? That's one way to avoid, being scammed by buying into something that someone's telling you, oh, I know how to time the market. You get in here, you get out there. No, look, just go do your homework, find great opportunities that suit your risk appetite, and invest consistently over time, right? Getting in and out because of emotions, right? These are all things that you have to understand about yourself when you begin to invest. The market will go up, the market will go down. There are better times to buy than others, right? So I would avoid at all costs emotional decision making, right? Emotional investing is never a great idea, right? So you want to make sound, factual decisions, right? Um, Watch out for fees and taxes. That's also something that you have to, consider as you are investing, right? What will this cost, right? How much will it cost me to sell in the form of taxes, right? Taxes is a cost. We're going to put that under the cost segment, right? So, what does this cost me to sell, right? One rule is how long have you had it? Have you had it a year or more? Okay, then I would certainly consider, selling, but anything less than a year, you might want to hold on to, right? So you want to make sound investments early so that you're not in a situation where you're forced to sell something before you want to sell it, right? Because if you sell it at a profit, that profit is going to be taxed slightly different less than a year than it would be over a year, right? So understand that. Um, and homework, it's up to you to understand what you're investing in, right? So do your research. You're going to have to constantly um, stay abreast of what's going on and whatever you're invested in, right? You want to you want to check on it. Okay, a lot of the publicly traded companies have quarterly earnings, right? So every quarter they will give you, an update on how the business is doing, right? The fundamentals. What does the balance sheet look like? What is the cash flow, right? How are sales, right? So these things are required, right? So even though you think school is over, no, you still have homework to do if you want to be a successful investor, and that means consistently checking up on your investments, right? So even though you might think it's a passive investment, it's passive that you don't necessarily have to get out and mow lawns or paint or fix broken toilets, but you absolutely want to continue to look at the financials, and when those financials no longer align with the reasons that you bought into said investment, you want to look to begin to exit that investment. So as a recap, definitely start early, right? You want to start as early as you possibly can, so that compound return uh, can benefit you tremendously. You want to set clear goals. So I don't know if anyone has ever heard of SMART, right? SMART financial goals, but you certainly want to set SMART goals, clear, concise, you know, goals. You want to develop a personalized investment plan, right? That's basically understanding who you are. Your investment plan should fit who you are, not who your best friend is, not who your sister, your brother is, your mom, your dad. Because once you've developed a personalized investment plan, you're more likely to stay the course than you would if you did not, right? Resources. In today's day and age, resources are everywhere. You got websites like Wikipedia. That was probably one of the first websites that I ventured into, and Morningstar is probably the second, right? So those are pretty old at this point, but you have a lot of resources. Even some of the bigger brokerages, like if you go to the Merrills, the Morgans, the Charles, they have a lot of resources in place that will allow you to, go through everything that they offer, right? Uh, Professional help is also an option, right? Do you have an advisor, right? Are they a certified financial planner, right? So that they can look at your entire landscape of your portfolio, not just one or two investments. They'll factor in taxes. They'll factor in what you pay for your mortgage. They'll factor in everything. Okay, this and they may also have some additional information about any investment that you're in, especially if they're publicly traded um, companies. And be cautious about um, ad- advice, right? Just like with a doctor, get a second opinion when you're seeking professional help, right? So educate yourself. I'll say it again, we're in a time now where it is extremely easy to find the information that you're looking for, right? So you certainly want to seek help and advice, and you don't just have to get it from one place. You could again consult two, three people, but ultimately it's your money. You make the decision, and if you don't, you have to live with it one way or another. But As long as you're making sound decisions based on your personality, your risk appetite, you'll be fine and continue to grow your money as long as you're picking the right investments. And that's it. Any questions? Is there a way to?
Yeah. So, okay, Shaun. So, thank you so much for the presentation. We'll keep you around there so we can have a conversation. So, there's a couple of questions, but first, let me just I want to summarize and hit some highlights of what you talked about. So, we talked about the fact that so many of us were raised with just savings, but Shaun pointed out to us as if your money is just simply sitting, you're losing money because of inflation. We don't factor in inflation. So your money should not just be sitting; it should be working for you in order to make more money. Okay, you talked about the different types of investments, and the one thing you want to be comfortable with is when you look to invest your money, you should be comfortable with the investments. Okay, so you have to evaluate your risks depending on your age, depending on the amount of time as you're investing your money, either short term, long term, mid or moderate. You have low, moderate, and high risk factors. Excuse me, high risk factors you have to take into account. Okay, what are your goals? What are you trying to accomplish? Right. One of the things we subsequently learn as you age is the earlier you start, the better off you'll be. If you can teach your children, if you have anyone under 21 years old, if you can teach them to start investing at 18, start investing at 21 consistently over a period of time, the beauty and the power of compound interest is that once you do the calculations, you can see any person could become a millionaire if they're just consistent. And one of the challenges we have is that I said the middle class, we are taught to spend. We run the economy. As soon as we get a dollar, the iPhone 16 is coming out, $1,000, $1,500. I got to get that new. I have a son. I'm going to call out my son, the oldest. Any new phone that comes out, he gets on the plan. He's an early adopter. You have the early adopters. I'm a late adopter. I'm the one spending the money. he's an early adopter. He got to get that phone the day it comes out. So we have to be mindful of your strategies. What are your goals, long term, short term, and then work to build a portfolio. And that's one of the things when you start learning about investing, they drill it into your head to diversify your portfolio. So he gave you the macro in terms of stocks, bonds, mutual funds, real estates. But like he said, if you listen to any of the investors on TV, like a Kramer, they talk about also diversifying your portfolio inside like your stock portfolio. Talked about common mistakes to avoid. And one of the questions we had from Elder Belinda is, how do you determine the best way to start investing in crypto? And I think Shaun answered this question. But the thing you have to understand is never invest in something you don't personally understand. So I myself, I never really got into crypto because I like stocks. I understand stocks. There's something behind the stock. There's a company behind the stock. If you buy gold, you understand it is there's an asset behind that. If you buy real estate, right, there's an asset behind that. If you buy land, there's an asset behind that. Crypto has nothing behind it. So I know there are people who made millions in crypto who were able to, like Shaun said, you don't try to predict, but they were early adopters. They got in when crypto first came in. When it shot up, they became millionaires. They were able to get out. The people who got in late, they could have lose their shirt because it went back down. And now you have to wait until it comes back up again. And now it's back up. So Elder Belinda, a person of your stature, a person of your financial positioning, I wouldn't personally recommend you invest in crypto. I would recommend, and if that's something you want to do, then study it thoroughly before you make a decision to invest. And one of the things you have to understand in the financial space, you see it on social media, the way America works. I'll use Shaun. So Shaun becomes a successful investor. You know, he has 5, 10, 15, 20, $30 million in his portfolio. What he does, he puts a curriculum together. He sells the curriculum for $99.99. He goes online and he tells people, hey, I started out working a job just like you. You know, I took my portfolio from $20,000. Now it's $10 million. And for $99.99, I can show you to do the very same thing. And like Shaun was saying, what subsequently happens is now he's making more money selling his training program, his curriculum. And there's nothing wrong with that. That's the American way. Don't get it twisted. That's why at the end of this we put up the Cash App, because we are giving you vital information. The information we're giving you, I know, even though we're pastors and we're doing it from a community standpoint to help the betterment of the people, but the things I'm giving you from Dave Ramsey, I paid for. We paid to get Financial Peace University to be able to teach that. This information, we paid for the books to share with people. This information we're presenting to you has a tangible value. We're aware of that. Okay, so this is important for you to understand. Just because, and that's one of the challenge. Why we put up the Cash App is so you can invest in your own education. So Minister Belinda, to answer your question directly, again, do not invest in anything you do not study for yourself. Okay. He also talked about starting early as possible. Another question that came up, Deacon CJ asked, are dividends taxed more aggressively than selling the investments? And you have to understand, when you're dealing with any type of investments in our country, there's such a thing called capital gains tax. Okay. So capital gains, you're taxed on the return on your investment. One of the challenges you have, and a big kerfuffle that Joe Biden got himself into, he wanted to tax unrealized capital gains. That means, say you bought a stock for $100 and that stock goes up to $1,000, and for my math's sake, let's say it goes up to $200, you have 100% return on your investment, but you have not sold it. He wants to be able to tax that $100 you made, even though you did not sell the asset. And that would just crash the economy, because the billionaires who have their money invested, right, who reinvest and never really sell the assets, if they're going to be taxed before selling the assets, believe me, they're going to take all that stuff out and put it on an offshore account or something to keep it away from Uncle Sam. So the taxing is going to be consistent. It's just capital gains. Okay. And there's one of the things I realized is that I don't mind paying the capital gains if I have capital gains. If you're making money, if that $1 made you another 10, hey, Uncle Sam can have 30 cents of that or $3 of that, because I just made another 7 off the one. So, okay. But one of the things I wanted to talk about, so I know some people might be saying, and not just on the live, but if you're watching this Facebook, you're watching this Instagram, you're watching this on YouTube, and one of the questions is, okay, where do I get the money to invest if I'm just living paycheck to paycheck? Or where do I get the money to invest if I have a little bit left over? But the reason the rich get richer is because they have a significant amount of money to invest. And one of the things, what we get is we get locked, right? You get focused on what just you have. And one of the things we never think about is being creative, right? So I got into real estate because my mother called me up one day and said, send me some money. We're going to buy a quad. She moved to West Palm Beach, Florida, right? And I got into real estate investing with my mother. I was working a job, and on the job, we decided, some of us, that we were going to start a investment club called a high risk investment club, and we were going to invest in high risk stocks. Okay, and what we did is we put an investment club together. In this case, we used Charles Schwab and you basically sign a contract. Okay, everybody puts up a certain amount, 500, 1,000, and then if 10 people puts up, we all have 10% of the investment club, right? And now we're all researching stocks. We're all working together, coming together as a unit to invest. So I only say you only had $1,000 and you can't, or you only have $100. You can't do that much with that. You get 10 of your friends, you get 10 of your family members, right? And again, it's a contract. Everybody signs the contract because they have to be put on the account. When you open the account, everyone who is part of the investment club has legally has a legal stake in the account. Okay, so when you do things like this, you want to do it with people who are like-minded, business orientated, and make sure it's people that 2 weeks later it's like, yo, I need my $1,000 back. Because now the other 9 people got to come up and buy that person out, right?
Right.
So if you're sitting down and thinking about doing something like that, make sure it's with like-minded people. Make sure that they understand we're going to put this money away, and it's going to be 12 months, 18 months, 24 months before you can even see to get this money back. So that's what I'm trying to let you know, and something we don't think about is ways by which you can begin to even think about investing. Part of the reason we started the Road to Financial Freedom, I wanted to do in January to get ahead of people. So when they got their tax return, it's like, hey, don't spend the tax return. Don't spend the tax return, right? Begin now this year, because even if it's just a tax return and you consistently begin to save and invest that, say you get $1,000 a year, right? In the end of 10 years, that's $10,000 that you didn't even have to take out of your paycheck. Just don't spend it. So wanted to deposit that, because when we talk about generational wealth does what? Spans generations. So say you're a grandmother, right? And you have a little bit of money. You talk to your daughter or your son, they have a little bit of money. And if your grandkids are old enough, they have a little bit of money. All of y'all put your little bit of monies together, right? Parents, you have young adults in your house. I've heard stories where when the young adults became of age, parents forced them to pay rent. And when they were ready to buy a house, all the money they paid in rent, the parent gave it back to them and helped them at a down payment. They didn't realize the parents were saving all that money for them. Okay. And these are the things you could try. These are the things you could implement. These are the things you can do to help your children by teaching them responsibilities. So I know some of you, we've had discussions. I won't throw anybody's names out there, but some of the members of the church have discussions of, should we charge our children rent? Well, they're going to have to pay rent eventually. You're not taxing them, you're building ethics in them, and then you could turn around and save that money, set that money aside, so when in the future, instead of them spending it on a new iPhone and spending it going out and partying with their friends, or spending it on pizza and donuts, you can invest that money for them, so when they need it, it'll be there for them. Okay, Deacon Charles asking, what are some of the best resources and podcasts, or something to the liking that both of you listen to? So go ahead.
So
what
Charles
kind
Schwab has a YouTube station that I watch almost every day. I want to say they go live on it, and they actually have classes where you can ask questions, right? They have all types of different strategies, whether it's futures, options, stocks, right? They have one. Also, if you set up an account with them, they have
Yes.
courses that you can go through.
Yeah.
They have I want to say it's like it might be like a 4-hour stock course, like a 6-hour options course, right? So they
Yeah.
have a lot of resources if you, and all you got to do is set up an account with them. I don't believe there's a minimum to open an account with them either. I'll have to double check that. But some of the bigger brokerages, they have all of the resources. I'm not a big advocate for some of the smaller, newer ones like the Robin Hoods and the Weebles and all of them. Like if you go to a credible brokerage, they have all of the resources that you would need.
Yeah, no. So yeah, I've been with Charles Schwab since the '90s because I used to work for Merrill Lynch, and Merrill Lynch at the time was a um, full service brokerage, and then they charged more. So when I left Merrill Lynch, I went with Charles Schwab, and I've been with them, and I can confirm what Shaun is saying. So I also have a Webull account, okay, and the Webull app. If you listen to any of the investors on YouTube, they would have you join Webull, and if you use their code, you'll and then say you deposit $500, Webull will match it as well as give you free stocks. Webull, Mubu, Mumu, and Robinhood did the same thing when they started, and they do that in order to entice people to join. Okay, and again, all of these brokerage firms, all of them, they have training. They have training. They have resources. Um, we live in an age of social media. There is a plethora of individuals
Yeah.
on YouTube. There's a black guy on YouTube. I can't think of his name right now. Well, there are multiple black guys, but they also have like their own universities that you join. You when you subscribe, you subscribe for their channel, and then you join the Patreon, right? And um, you join their community. You can actually watch them trade. I mean, stocks, options. I mean, they talk it through. So there, we live in a time where there is a plethora of information in order for you to get a better understanding, um, whether it's YouTube, whether it's Instagram. Yeah, yeah. The information is out there. The information is out there.
As far as
And
real estate, I like bigger pockets too. Bigger
say
pockets
that
is
again.
a good one. Bigger pockets is a good one for real estate. Like if you're
Yeah.
interested in investing in real estate, I like bigger pockets. They have YouTube, Twitter, everything.
Yeah, and the thing about real estate, okay, real estate is I'll just use you, Shaun. Um, just about any of us can do real estate just the way Shaun and his wife did it. You know, they bought their first house. They were first time home buyers. They were able to take advantage of the program for first time home buyers. But I believe there was a requirement that you had to stay in the home for what, 5 years?
I think it is, but we didn't have a first time program. We just bought it.
Okay. Okay.
Yeah.
So yeah, but so you take advantage of the first time home buyers program, and I was recommending this to somebody just the other day. And sometimes there's a requirement. So say you have to stay in the home for 3 to 5 years, right?
I think
And
it's
that
like an
time you
FHA loan. I think that depends on like the loan or the
okay,
program.
the
Yeah.
loan, okay. But
Yeah.
then you build up equity. You build up equity in that home, right? And most of us, when we're starting out, we get the starter home. You know, right now, a starter back in the day, a starter home was like mid twos. Right now, it's probably high twos or low threes. Okay. You build up some equity in it. And then when you're looking to get your second home, instead of selling that house, you take a loan on the first house, you buy the second house, and like Shaun says, you rent out the first house, and then and then basically what you're beginning to do, you have you someone else is now uh, building equity for you. Okay,
Mhm.
so now you have two homes, and someone is paying off a mortgage for you. So at the end of the time, right? Say whatever the mortgage is, and let's just say you don't do anything, you just maintain the home 30 year, you get a 30-year mortgage. At the end of 30 years, someone has paid off that house for you, right? So now instead of having one house worth, $300,000-400,000, okay, remember the thing about real estate is that for except for back in 2008 when everything was upside down. Real estate always goes up, and as you notice, what 14 years later, it's back with a vengeance. Okay, I can tell you because I was upside down with some real estate, and I guarantee you, it's back with a vengeance now. So
So
just that.
that was when we bought our first property in 2008, 2009. So it was just coming out of the very bottom. So we got a great deal on it, and that allowed me to continue to hold on to it. Understanding finances and the market, right? They always say buy when it's blood on the streets. Like that's
Oh yes,
a
yes,
common phrase, right? So when
yeah. That's
everyone's
why they call
running
them
out,
sharks.
yeah. So when everyone's running out of the house, you running and buy, right? And
Yeah, that's why they call them
if you can
sharks. One of the
identify
challenges. Go
go
ahead.
ahead. Now I was gonna say if you can identify those opportunities, you'll make the most money, right? So, and that's kind of what we did. So, you know, we was fresh out of no, not really fresh out of. We was newly married. I think we was newly married, and it was my first corporate job out of college, and I think I sold some of my stock from that company, and I bought when blood was in the streets,
Yeah.
right? And I was able to
And
hold
that's
on
the
to it.
thing. That's the thing. Individuals, okay, those of you who are hearing us. So one of the challenges we have, especially in the church, is that people seems to think it's cruel to take advantage of a situation. So let me give you an example. Maybe someone in your family is about to lose their house. They're about to be foreclosed on. They wait until the last minute for whatever reason, or somebody you just happen to be aware of, right? Um, First of all, if that's the case, call me because what will happen is what we call a win-win. Instead of them losing the house, right? We can pay them. Say, hey, you know, instead of you losing the house, I'll tell you an exact situation that we did in the previous church. One of the members was about to lose their house. I'm like, the real estate agent brought it to my attention. I paid the woman $10,000, gave her $10,000 cash, paid the arrears, so what she owed, and then I took over the mortgage, and then she rented the house from me. Okay, so instead of her losing the house completely and going and having to find someplace else to live and have no money at all,
Right,
she got cash. She got to stay in her house. Okay. And basically, I reduced, so she's paying me rent. I'm paying the mortgage, but she's paying less than because she couldn't afford the mortgage in the first place. Right.
right,
Right. So that's what you call a win-win. And because we did a quick claim deed and the mortgage was still in her name, came tax time, she got to write off. I'm paying the mortgage. She got to write off the interest. Right.
but you was able to cash out with the appreciation.
Yes, I cashed out on the appreciation,
Yeah.
big time. But that's a win-win. And a lot of times people were like, "You're taking advantage of a No, you're not taking advantage of a person. You're actually helping a person because if they don't, they'll lose their house." Now, one of the things. Okay, so here's another question. Not sure if you discussed it, but what are your thoughts about using life insurance to get money in order to invest? Okay. Now, one of the things. Uh, because of Dave Ramsey, right? One of the things we talk about is you never go in debt to invest. I'm gonna say that again. So sometimes people will tell you, okay, you can get a credit card, $5,000, $10,000, 0% interest for 12 months, and then you could take a cash advance and take that money to invest. You can do that. We don't recommend doing that. We don't recommend going into debt to do that. Because one thing you learn in this space is there's no such thing as a sure thing. Shaun alluded to this. The market could flip on you on a dime.
Yeah.
Okay, I give you a prime example. So in the stock, there's Shaun told me about Nvidia. I've been tracking Nvidia for a long time. Nvidia is the leader in the AI space. So when it split, I bought some shares because it split, and since it split, all it did was went up. Literally, all it's done is went up. It split at like 120. I bought it at 122, and then it subsequently went up to 140. right? And I was on the way up. I figured, hey, this thing is not going to stop. So I bought stock options for July 5th at 150 when it was at 140,
Yeah.
right? Because she's like, yo, this thing is going, you see what I'm saying?
So parabolic, yeah.
And then, soon as I did, hear me,
It pulled
people,
back.
hear me. Soon as I did that, next, I think, yeah, the next day,
Right?
it
Yeah.
went down and down and
3
down
days. 3 days
under
in a
what I
row.
paid. It went down to 118,
It went down to 115. Because I've been
115.
watching. It went down to 115. But yeah, I think that's I'm yes. That's
Yeah, and it's
exactly
back
what will
up to
happen
one. It went back up to 126 today. So it's back
today.
up,
Yeah.
But all I'm saying to you again, I got some time in there, but all I'm saying to you is Shaun said it, and I think you really reiterated. I'm going to reiterate it too. You cannot predict things. You cannot time the market, because if people could, they would be billionaires, right? You
They would
cannot
be
do that.
trillionaires. But and anyone that tells you they can turn and run fast.
Yeah. So, isn't so Charles made a good point. Okay, isn't taking a loan out from equity of a home to purchase another one going into debt, and there's and the reason why there's a difference in what we're talking about here is that um, mortgage loans tend to have lower interest rates. I mean, we know things are a little higher now, but mortgage loans tend to have a lower interest rates, and the equity, you're buying land or you're buying a house, you're buying an asset. The thing about companies is, the company could be doing great today. The CEO could do something stupid, or the board could do something stupid, has nothing to do with you, and the stock tanks. I'll give you a prime example. I bought Carl Icahn. I bought his shares because they gave a high dividend. Okay, at the time they gave $1 for every share you bought, and I bought it at $34 a share. For every share you bought, they gave $1 dividend, which is percentage wise was kind of high, right? And right after I bought it, several weeks or so later, they had some kind of lawsuit kind of thing. Okay, they had some kind of lawsuit, and it tanked the stock. Fortunately, I think there was a $2 a share for dividends. The stock is at 15 now, and they still give $1 a share dividend. I still have the stocks, right? So it's a long-term investment. I bought it because it paid quarterly dividends. But that's the challenge you have. See, with real estate, number one, you're taking a loan, right, out of your equity, out of your first house, to buy something that you're going to live in, you're going to take care of, and all things being equal, short of the aliens coming or short of Russia bombing us, right? I can pretty much guarantee you that at the end of the cycle, that house is going to be worth 1.5 times whatever you paid for it. Okay, we stayed in our house 20 years. We paid $300,000 for it, and now it's worth $6 million. We stayed in the house since 1998. You do the math. That's real estate. And if
Yeah,
you
real
go ahead.
borrowing against your equity in real estate is a little different because you also avoid having to pay taxes on the sale, right? So
And you're borrowing from yourself, pretty much. I'm not going
exactly,
out to
you're borrowing
I'm
against
not going
yourself.
out to a third party. I'm not going to MasterCard. I'm not going to Visa, right? I'm not going to somebody. That's why do you think once you qualify, why do you think the banks will give you the money for a house? Because if anything happens to you, they still have the asset. That's why I like real estate, because stocks fluctuate. They go up and down. Real estate don't normally do that. And you can drive up to your asset. You can see your
And
asset.
insure it. You can insure your asset.
You can insure your asset. Okay, so that's the biggest difference, Charles, and it's a good point because it always comes up, debt. And the thing about real estate too, and what I tell people, um, if you look at the amortization schedule on real estate, they tell you like when you first start, like you pay principal, interest, taxes, and insurance, but only $1 goes to principal.
Yeah.
What you
Yeah.
need to do, what I used to do on all my properties is they have a payment for on time and they have a late payment. So say the payment for all time is $1,200. Say the late payment is $1,250. I paid the $1,250 on time. So I always paid extra to the principal. You may not think it's a big deal, but just doing that alone could cut 5 to 8 years off of your loan. So instead of a 30-year loan, you end up paying a 22 or 25-year loan. Simple things like that. And once you get comfortable paying the extra, it's an extra $50, an extra $100 a month. It's in your budget, so it does not hurt you as much because they say your mortgage is 1,200, but you're paying 1,300, right? And the other thing it guards against what I used to hate at the end of the year when they do the escrow assessment, and then they come back and say, "Well, you're $500 short on your escrow, and we're going to have to raise your mortgage payments." Like, why am I short?
Right.
Okay. I used to love it when they say you're over and they sent me a check in the mail, but that only happened once or twice over the period of the time. So that's one of the things we're always challenged with. So I should say you should not go into credit card debt, right? With the idea of, I get 0% interest over here and I can make 5 to 10% interest over there, right? There are strategies you can use. And here, this is investing 101. There are more advanced strategies, okay? But you first have to get the basics. And the basic is education. The basics is education. I'll say it. If you don't manage your money will manage you, okay?
Right.
And part of your responsibility, okay, is not how much you make, it's how much you get to keep. There are forces, right? With the initials IRS. There are forces out there whose job is to separate you from your money. And one of the things I learned very young, I don't envy rich people. I emulate rich people. Okay. When Donald Trump told Hillary Clinton to her face when she tried to call him out for not paying taxes, he told her to her face, "That's because I'm smart." And that is absolutely positively correct. Okay. That's because he's smart. If you understand the way they have us coming and going in the middle class, you get your paycheck, they tax you. You pay federal and state in Georgia, right? You go to buy a car, you got to pay taxes on that. You buy a house, they tax you there, right? You go to buy anything, sales tax, right? If you invest your money, you get a return on investment. You got to pay capital gains tax, right? You get a bonus, they tax you there, right? The whole idea of as individuals, okay, those you who two income earners, you're in the top 15, top 10% in the country of earners, right? Because you're making 6 figures plus. What you have to learn how to do is how to keep, right? Part of the reason I like real estate is because it gave me something to write off, right? Because you got to understand, you can make it, but Uncle Sam will take it. Okay, so strategies like this, investment strategies and things like that, bonuses are taxed at a 33%, right? So what you have to understand is you have to get out of the mindset of just barely surviving, number one. Number two, you have to get out of the mindset, middle class, upper middle class. No, okay, because you have people who earn middle class earnings who retire wealthy. You have school teachers, you have school teachers, firefighters, police officers, who earned, civil servants who earned while they were working just middle class salary, but they had strategies of investing their money, long-term strategies, whether it's a 401k, 503b, 403b, I think it's called if you're in the school system. Y'all correct me if I'm wrong, but strategies, long-term strategies, besides your home, just putting a little aside, consistently putting a little aside. And our grandparents and great grandparents understood you save for a rainy day. Today we don't do that anymore, simply because we have credit cards. Okay, and we use our credit cards as our saving mechanism. Okay, 503b. Thank you, Mr. Don. We save our credit cards as we use our credit cards as our rainy day funds. That's not the case. You want to begin to the idea of this training is a mindset shift. Okay, I saw Deacon Veronica McCoy on in the chat, and I hold her up as my best financial student ever, because I taught some things and she actually listened to them, implemented them, and now she's retired. Right, she's retired. She has 2 homes. And she's not eating dog food for dinner. Somebody say amen.
Amen to that.
Right?
Yeah.
With inflation and this economy, you have people who working who can't make it, but yet she implemented these strategies 20 years ago, and because of that, she's able to survive today. Unfortunately, we've had people who retired and had to go back out to work, because in retirement the money wasn't meeting, right? Ends wasn't meeting because the money wasn't there, right? So understand people.
Delayed gratification is really a thing. Try to delay gratification.
Yeah, it is. It's never too late to start, and it's never too early to start. Right? It's never too late to start, never too early to start. So it's just a matter of beginning to implement strategies, and like Shaun was saying, right? Sit down and figure out what is your goal. Do you want to retire? Some people want to retire early. They want to retire at 50. They want to retire at 55. Okay. How do you do that? You want to retire at 65 and be able to maintain your lifestyle, be able to travel all over the world. How do you do that? Okay. You do that by starting today. We just again, if you think of it as a college curriculum, we just gave you 101. We just gave you the basics. Okay. Hopefully begin to stir some thought. And I want to thank Shaun for coming on and presenting and having this dialogue and discussion with us. I'm going to see.
Thanks for having me.
All right, it's always a pleasure. I don't see any more questions in the chat before we're getting ready to sign off. I'm going to ask Pastor Nedra real quick to put up the Cash App, like we said, we'll always do, just to be able to support the program. Right? We don't ask for much, right? But hear me when I tell you, the information that we're giving you, I know is valuable, because just like Veronica and just like Shaun, just like myself, we practice, we try to implement and practice what we preach. And we know the information that's being presented is valuable, because it's the same information that if you went to any it's only 1 hour, but if you went to any investment 101 class, this is the type of information you would get. The thing is for you to take the information that's presented and begin to do a deep dive. Okay, begin to do a deep dive. Remember, your money should not be sitting; it should be working for you, making more money. Okay. You need to understand risk. Don't invest in anything you don't understand. Listen to me. Listen. I'm waving my pen at you. Listen. If it's too good to be true,
it is.
That's one thing anybody in investment space, you learn this, either you learn it the hard way or you get it. If it's too good to be true, it is.
Mm-hmm.
It is. Let your street smarts kick in. If someone is promising you 50% return on investment, 75% on return on investment, that's some kind of Ponzi scheme.
Yeah, get out of it quick.
Yeah, it catches a lot of people because greed kicks in. One of the challenges you have, and I'll say this, we're prepared to depart, but one of the things you have to be really mindful of, especially when you're investing, is greed will kick in, and you have to be disciplined. Okay, that's when Shaun talks about goals. You have to know what your goal is. So if you're doing a short-term investment, say you're buying Apple and you want to do it a short term, and you should know when you're going to get out while you're
Before
getting
you
in.
get in.
And once you hit that goal, don't go for another dollar, because it's better to make $100 and be grateful than to make 100, try to make 110 and then lose the 100.
Mhm.
Hear me when I tell you something. If you're doing any kind of trading,
It happens.
consistently buying and selling, it's something you have to fight every day, and you
Yeah.
have to begin to convince yourself it's better. No, actually, put the buy it and then put the sell order in at right after. So as soon as they hit that target, you're not even, because you'll fight yourself for a dollar and end up losing a lot.
Yeah. Yeah.
Okay.
FOMO is another thing too. Fear of missing out.
Yeah.
Sometimes you're just gonna have to miss them.
Yeah, and the beauty, here's the other thing you learn if you're trading or if you're investing. The beauty of the country in which we live, and the stock market, you can make money every single day, and you can lose money every single day. Okay, every day. So you don't have to be fearful of missing out, because tomorrow is a brand new day, and there are stocks that we have not even heard of, right? So, unless you're up on things, there are companies, there are robotic companies, there are companies that people have ideas about that hasn't even started yet. That once it starts, there's going to be a ground floor. There's going to be opportunities for you to get into. There's just like there was a Google, just like there was an Apple, just like there's a Microsoft, just like there was an Nvidia. Something else is coming behind that.
Yes.
Once you understand that, money can be made every day. Don't cry over spilled milk. All those little things. All those little things help out. But again, remember to support. And I want to thank Shaun for coming on. Thank each and every one of you. Remember to share the broadcast, put it on your feed. And the thing is, especially if you have family members, they're like-minded. You want individuals who are like-minded, okay? But there's no reason why you can't begin to start researching investing and getting into investing sooner rather than later.
Yeah, I'm gonna leave y'all with this. Like, even if y'all don't have money to start investing today, start a little garden, right? I think that'll teach you a lot about investing, right? You got to sow a seed, make sure you have fertile soil, a viable seed, watch it grow over time to produce fruit, and then you reap the rewards of that fruit when it's ripe.
Yeah, so just give me some of your grapes, some of your tomatoes, some of your cucumbers. Shaun actually has a garden. Why? That's why he's telling you to start a garden, because
Yeah.
he's
And
actually practicing what he preaches. He actually
patience
has a
is a big
garden.
part of it too, though.
Go ahead.
Investing patience is a big part of it, right?
Yes, it
You're
is.
not going to plant your seed today and expect fruit tomorrow, and that's a lot like investing.
No, that straight facts. Straight facts. But again, thanks you guys for sharing. That's all we have for tonight. We look forward to seeing you on next month, and you guys have a blessed evening. And again, thanks, Shaun, for pitching in. Have a good night, everybody.